Ladies and gentlemen, to the financial analysts and economists, there is no greater uncertainty than the world of macro and markets. Analysis and assumptions are constantly changing with updated economic data and new disruptions. But in keeping with our exploration of embracing the unknown, shifting sands and structures offer new opportunities and open frontiers for global inclusive growth. Here to unpack whether there is a light at the end of the tunnel, please welcome Alan Ng, Group Head and Principal Economist, ASEAN Plus 3 Macroeconomic Research Office, Kevin Bong, Managing Director and Head of Portfolio Design and Construction, Total Fund Management, CPP Investments, Shan, Partner, Hutong Research, and our moderator for this session, Mohamed Ridzuan, Director, Research at Khazanah Nasional. Over to you, Rids.
Hi, good morning. All right, thank you for having us on the panel. Welcome to today's first panel, which is on macro markets with the title of "Is There Light at the End of the Tunnel?" It's been pretty clear for a while now that financial market returns in ASEAN have been pretty poor, right? In the last 10 years, ASEAN and the KLCI have generated something like 5% a year compound returns, whereas you compare it to, say, Europe and Japan at 8%, and the S&P 500 is just blowing everyone off at 15% a year, right? And the question here is why, right? It's not just about US big tech, right? Because ASEAN's underperformance is pretty chronic and broad-based. It's probably more likely due to something more intrinsic and fundamental to ASEAN. Alan, you've done some work on ASEAN structural growth, right? Why this funk in the past 10 years?
Good morning, everyone. Thank you, Ritz. It's so good to be back here in KMF. After the fantastic session with Sir David, I'm not sure whether I know anything anymore.
That's a humility, right?
Yeah, right, and mission, really. I think for the case of ASEAN, it's important for us to get the right context. ASEAN's growth has slowed. I think it was in year 2000 or so, it was growing at about 6%. Now it's growing close to 4%. But even at 4%, ASEAN is one of the fastest growing region in the world. I think that's a very important point to acknowledge. With the exception of South Asia, ASEAN is the fastest in the world. And ASEAN's level of per capita income is more than double that of South Asia. But the slowdown really comes from the fact that it coincided with the ascension of China into the WTO. So when we look at the major ASEAN economies, when the slowdown happened, it's also corresponded with the peak in which most of the major ASEAN economies has reached in terms of the share of manufacturing in their economies, and then it was trending downwards since then. So I think that a lot of that, when you break it down, the growth, the potential growth, you can see that a lot of the slowdown comes from the fact that capital accumulation and TFB growth has not been as high as before. And that's a very important point. But I think another key thing to appreciate is that the last 10 years, the external environment has not been very easy as well, right? 2016 started with Brexit, and then the first trade war, then we had pandemic, and then of course now we have the second trade war as well. So that, the changing structure of the Asian supply chain plus the external environment has shaped that slowdown in a way. But just to end my intervention, actually there's another very important shift that's currently happening at the moment. For the first time ever, the net international position of China, investment position of China, has turned positive even when you remove foreign reserve. So the net international position of China has always been positive since 2000 when the data is available, but most of it is due to reserve accumulation. And the private sector part of it has always been negative, so they are net receiver of capital, FDI, into China. But that has changed last year. And in 2024, for the first time ever, if you remove reserve, its net international position is actually positive. And I think that will bring really transformative changes to the nature of capital in Asia. And I think ASEAN will be the ground zero for that change. So if I may, if the last 10 years for ASEAN has been about resilience, dealing with the slowdown in potential growth and the very challenging external environment, I think the next 10 years will be about transformation and how we can actually leverage on what is happening now currently with the inflow of capital that is coming from China, as well as how to deal with the changing landscape when it comes to the global power competition between US and China. Let me end here. Yeah.
Yep. So slowing growth in ASEAN, you're saying, has been due to slowing capital accumulation, right? But having said that, I guess there are big differences in how capital is accumulated, right? It's either you have domestic DDI, you have FDI, right? And historically, DDI in ASEAN has not been particularly transformative, right? You have, if I take ASEAN as a whole, it's primarily going to be tycoon-led somewhat, I would guess. And they tend to focus on very domestic-centric sectors. They tend to focus on a lot of extractive sectors, rather than like, as opposed to FDI, which really kind of shifts the product space upwards in terms of higher tech, higher wages, etc. Right? Would you agree with that kind of thesis?
In a way, yes, because I think the growth, the frontier growth for the ASEAN region has always been driven by FDI-led kind of activities. Even if it's a private sector and it's not FDI-led, it's actually linked to the external sector. So it could be domestic firms, but they're actually investing for an external market. So I think the reason why there is a slowdown is I think there was a slower growth in FDI and its impact on like the domestic ecosystem for most part of ASEAN for the last 10 years. But I think that's changing. I think we just want to highlight one very important point. So in EMRO, we do our usual annual forecasts for the region. And at the beginning of the year, we were very concerned about ASEAN's growth prospect for this year, given, back then was really the Trump tariff and Liberation Day. One of the areas in which we were really concerned about was actually the drop in not just external demand, exports, but also in investment because of the significant uncertainties and how companies might wait and see. But that didn't actually pan out as how we actually initially feared. In fact, investment has been actually supporting growth for most ASEAN economies. In fact, in the second quarter, the growth that comes from investment was pretty high. And when we look at the nature of the investment, a lot of it is actually coming from FDI itself. If data is still nascent at the moment, but when we look at some of the indicators that we have on FDI, such as FDI applications and so on, across most ASEAN economies, we are seeing really strong interest. And they are in new segments like advanced electronics, EV, and data centers and so on. So those are actually have been supporting growth. And I think that this speaks to the comparative advantage of the region, ASEAN. Its neutrality, in a way, is actually supporting this inflow of investment. So neutrality in ASEAN, in fact, is its comparative advantage. Yeah.
Right. So historically, FDI has driven ASEAN kind of innovation, and today you're painting a positive picture with respect to Chinese inbound FDI, with the whole AI cycle kind of spurring a new wave of FDI, manufacturing FDI, and it's great timing, right? It's more urgent now that, if I think back 20 years ago, it was really only Malaysia and Thailand which faced the middle income trap. Today, you kind of see it even in Indonesia, and that's a huge chunk of ASEAN GDP right there, right? So kind of pivoting to the global success stories of economic transformation, Kevin, what's it like in the US, right? We've all heard of the phrase, software eats the world, and now AI is apparently eating software. And is this endless cycle where the Mag 7 just get richer and richer?
Well, first, congratulations on your 20th anniversary, KMF for KMF, and thank you for having me. I feel like the Mag 7 have dominated the headlines for the longest time just because they have been driving very much all the change that's been occurring over the last little while. AI does seem to be the buzzword for everybody. There is a lot of potential, but again, along the lines of Sir David's talk just now and the epistemic uncertainty, there is a lot that we just don't know. And obviously some of it I think we will leave to chance as well. The US has been exceptional for a very long time for a whole confluence of different factors. Exceptionalism in many ways is a privilege, not an entitlement. I suppose, but we observe that of the US because of the innovation that occurs in the economy, the willingness to bring in the best and brightest from around the world. There's economic exceptionalism, and then there is obviously capital exceptionalism as well, and the US dollar being, I suppose, in many ways, the currency of trust and choice for the longest time. And that has given the US a very significant tailwind. So as this transformation has occurred with software and then with AI, I think that's been a big driver of why the US has been wildly successful compared to maybe every other part of the world. Whether that exceptionalism can continue, that really remains to be seen. It is a challenge for various reasons. Some of those factors that have driven the economic exceptionalism may be changing with shifting attitudes towards bringing in the best and brightest from around the world, with shifting attitudes towards how companies participate in economic growth. But at the same time, there is a bit of an advantage from perhaps reduced regulations as well, which might encourage some of that innovation. At the same time, that capital exceptionalism may be changing too, because of the level of trust and the relationship that the US has had with the world, and how that might be evolving over time. So it's not absolutely clear that exceptionalism will persist. If anything, it is very much an opportunity for the rest of the world as it tries to consider moving outside of what has been a very dominant engine of growth by one country towards perhaps two, perhaps more, as well as this emphasis on the increased importance of some level of security in your supply chains, in thinking about your own economic success, and also ensuring that employment within different countries actually can be reinforced through renewed emphasis on domestic industrial policy. All of these things, I think, are driving a certain level of change where once upon a time it may have been sufficient for one single engine of growth to push for most of that. I think the environment today creates a very different set of circumstances for most countries.
All right, and going to China, Shan, since 2015, it's been a massive success, Made in China 2025, right? We see Chinese companies dominating product space from EVs to renewable energy. But it's fundamentally a very different innovation transformation model compared to the US, right?
Yes, thanks for having me here, and I'm happy to share some perspective on China's innovation mechanism. So you're right that this is a very different system compared with the US, and I think also the next 10 years will be quite different from the past 10 years. So the past 10 years, China did very successful Made in China 2025, but it was not from a capital-driven perspective, but from a competition between governments, as you mentioned. There were competition between local governments on how to select the most innovative firms. There were also firms trying to identify the most efficient technologies and how to hit the market share that identified in the Made in China 2025. But that mechanism has led to the evolution problem we're having today. That means that China is having its excess capacity over demand. So for the next 10 years, we're actually looking at a new type of thinking about China's innovation. First of all, there is a trend of anti-evolution. That means like the firms must slow down a little bit, and there needs to be no more excessive investment in one field. So there was this talk in July by the president, and basically he's asking all the local governments, like, why do we all building the new energy vehicles at the same time? So that is a very important message that China needs to rethink its transformation mechanism that could be different from the past 10 years. At the same time, Chinese companies are looking abroad because domestic growth has been slowing down. And so it is external growth that is very growingly important for Chinese companies. As Alan mentioned, that this is the first time we're looking at Chinese companies going abroad. So it is more outward looking and looking at the external market as a driver of growth. So I think these two will be very different from the past 10 years, where it's all about domestic competition within China. And China in the next 10 years will be looking outward to seek for the source of innovation as well as source of growth.
All right, so I guess the big difference between China and the US is really about who captures the value from all this innovation, right? In the US model, it's really about your innovation. The point of your innovation is to build market and pricing power. The government just doesn't do much. It sits aside. And so it creates a winner-takes-all environment where it's just great for the stock market, it's great for shareholders. In the China model, the governments at all levels SOEs are killing other SOEs, they're competing with other SOEs. It creates a lot of competitive intensity, right? Better products at lower price, right? But there are just no profits to speak about in the medium term, which is not so good for the stock market. It's very ironic as who's doing capitalism better, right? Sitting here in ASEAN, like, what's going on, right? But in trying to link what's happening with China, happening in China and US with ASEAN, I guess the topic of the hour is basically US protectionism, right? It's a bit of a wild card. Shan, do you think the US-China talks can be settled by next year? And then what does a new normal trade environment look like? Because we've grown up with 40 years of just US consumerism, right?
By this month, I think.
Yeah.
Well, very optimistic. That's another thing that we have to deal with uncertainties. And so for us, we're looking at more substantial talks between US and China. First half of the year, it was mostly the two countries trying to find the guardrails, no more extraordinary tariffs, no more export controls on critical minerals. But then heading into the second half of the year, we are seeing like the two sides really finding things that they can do transactions, they can build some trust going forward. And we're looking at the two leaders going to meet this month, and then probably a real visit sometime next year. We're looking at Q2. That's something that could happen. So in the meantime, we're also seeing like China doing some small steps to build trust and to make transactions happen with the US, right? The TikTok, as an example. Also, China is claiming that it's not doing the preferential treatment under the WTO. So these are the things that we think actually the two sides are trying to find a way to stabilize their relationship. And we're really looking at next Q2 for something more substantial to happen.
Yeah, it's starting to look like the West can't compete in manufacturing with China. So therefore, the way out of it is to keep manufacturing in the West or through Western supply chains, but opening the door to Chinese technology through IP licensing, for example, right? And I guess, but of course, I mean, that's kind of the long run. And in the meantime, what's been happening post-Trump is China diverting its exports towards emerging markets. And I can tell you that this isn't really popular here in ASEAN, right? What happens is that domestic-focused SMEs are potentially outcompeted by hungry Chinese competition, right? And really, it's not politically sustainable sitting here in ASEAN. So China kind of has to fix its chronic excess supply and under demand, right? Quickly. But what's the time frame we're talking about here?
Time frame is very important, I agree.
Yeah.
And so maybe I'll share some perspective about like what China is actually doing and what China we're talking about. So there are very different stakeholders in China. We're talking about the central government, the local government, and the firms. The firms, we have the SOEs as well as the private firms. So I think that overall, China is learning how to actually go abroad. But the different stakeholders have a different experience, and there's this rather a generation thing that a lot of the Chinese companies actually haven't really operated abroad before. So they are learning a lesson. But when I separate all the stakeholders, I actually see that this is the time that China is really sincerely looking abroad. I mentioned that because we actually thought a very important sign is from the currency. So early this year, when Trump imposed this tariff on China, and everybody thought that China could mitigate that risk by depreciating renminbi, but that does not happen. So we think that the leaders in Beijing are pretty much aware that depreciating renminbi can mitigate some risk of the tariff, but can also worsen the relationship with other countries, because that makes like Chinese exports just flooding all the other markets. A more sustainable way is to have Chinese companies invest in other markets, just like all the multinationals did before. So kind of the most effective way to incentivize that to happen is to appreciate renminbi. So that has been done this year, but only gradually. So a stronger renminbi will incentivize Chinese companies to invest abroad, as well as to incentivize Chinese consumers to buy more. So that is really the pillar of rebalancing, but that's only happening at the central level. And the local governments, they are still in this competition team because they have a lot of metrics, performance thing to deliver. They need to care about tax sources. They need to take care about employment. So we're looking at a gradual process. And in the beginning, we think that, we mentioned there is anti-evolution call from the very top president. So then anti-evolution in China is not only about firms, it's also about local governments, right? You need to change their incentives. You need to let them think that consumption is as important as production. So there was a recent article from Chinese state media that you need to promote consumption in a way that you need to promote production. And that basically requires a lot of changes to the fiscal tax system. Like you need consumption tax. You need to share that tax with central and local governments so that local government has the incentive to promote consumption. So that was, all of this was stated last year at the third plenum, China's economic reform plan. But then when you look at like how the process to change the fiscal incentives, you can't really do consumption tax now. China's consumption is really still recovering, if not struggling. So you kind of need to wait for a good moment to do it. So we're probably looking at all these institutional changes to happen in the next 5 years. And the next 5 years is probably even more quite optimistic because we're talking about really difficult changes. China is running a fiscal system that has been supporting production for the past 30 years. So we're talking about changes to the system in the next 5 years, probably starting from some pilot program and then expanded to the nationwide. But this is the timeline that I'm looking at. And speaking of the companies that anti-evolution, right? And the SOEs, they have been the first ones that invested abroad. But the private companies were facing a generation of Chinese private businessmen that probably have never traveled abroad. So they need to learn the lesson, but that also takes time. The good news is that the daughters and sons of these Chinese business leaders, most of them are educated abroad.
Like yourself?
Yeah, myself as well. So these people know how to navigate the international environment better, and they know the corporate social responsibilities and to really how to work with the local community together. So we're optimistic in the medium to long run, but in the near term, we think that there is still a lesson to be learned.
I'd like to circle back what you said at the first part of your talk in terms of you're linking trade to currency appreciation. It sounds a lot like the Plaza Accord kind of deal. Is this the deal that we should be expected to see next year?
Well, I think that would be the direction, but that would be something very different. Because China has really studied this Plaza Accord a lot. And one lesson learned is that that is considered the trigger of the problems in Japan in a lot of ways. But then the lesson learned is that you can't do that really fast, right? The problem in Japan is that it happened basically in a year or two, currency appreciation. But then in China, like everything, stability is the first thing. So if you make it happen over the next 5 to 10 years, then the impact will be much milder and the risk will be also much less.
All right. I mean, we've also studied the Plaza Accord in depth, right? Alan, I mean, post-85 was great for Malaysia, right? You had a sharp evaluation in yen, then you had a flood of Japanese FDI into Malaysia and Thailand. It was super, right? And then you could sell to a rich Japanese consumer whatever services they needed, right? Is this a new renaissance for ASEAN, you think, if this happens?
Well, in a way, yes. I think just another point I want to add on the appreciation of the renminbi. I think with the difference here is that the Chinese capital, Chinese fixed investment has already been moving abroad, and I think when the returns, when the income goes back to China, I think it might actually create a very positive cycle in which it will actually lead to a stronger currency, higher consumption, and so on. I think that's good for everyone, including ASEAN. And I do agree with you in a sense that when we look at the trajectory for ASEAN, we could be seeing a renaissance of reindustrialization in a way, especially for some of our economies which have for the past 10 years, in a way have past 20 years, in a way have been deindustrializing. So for the big ASEAN economies, we do think that there is that option for that happening. And actually for the mainland ASEAN economies, I think that is really happening now. We're seeing Vietnam, Cambodia, and so on, which is actually rapidly industrializing. And a lot of it has to do with the FDIs that's coming from China and also beyond China as well. So I think prospect for ASEAN going forward is, I think, is positive in that regards. But what we need is actually to put in place some of the ability to absorb this FDI, leverage on it, for us to domestically upgrade. I think when we look at the Plaza Accord situation and the flow of capital into the region, I think what is really important is that might be a necessary condition for us to get FDI, but that's not a sufficient condition for us to actually have high growth. I think one of the things that both Malaysia and Thailand and some other economies in not just ASEAN but in the region, they managed to actually capitalize on is because of the nature of a few things. One is human capital. We have a very educated workforce that is just suited for the capital that was coming in. We have a very open regulatory system when it comes to foreign capital in manufacturing sector. And then there was concerted effort to actually grow the economy. We have industrial master plan in Malaysia. In Thailand, there's the Eastern Corridor initiative where they actually put some policy in place to turn this capital into something more meaningful than just factories owned by foreigners, right? I think that is key now. So I think we need to have that conversation again in ASEAN and how to turn the next wave of capital into something that is more durable and more tangible.
All right. Kelvin, you're a Singaporean sitting in Toronto, right? And you can probably perceive ASEAN from a more kind of detached perspective, living 1,000 miles away, right? So we all know that ASEAN needs to diversify away from Western supply chains and as well as the Western consumer. And this means basically attracting more Chinese FDI. But the nature of Western FDI versus Chinese FDI is actually fundamentally quite different, right? Don't you think so?
Sure. Well, I'm still heavily invested in Asia, obviously, since the family is here. But I suppose whether or not distance gives you perspective is one thing. If you just think about the nature of FDI between, I guess, Western FDI, as you put it, versus perhaps Chinese FDI, Western FDI tends to be a labor cost arbitrage set of activities. There is production costs that tend to be higher if your economy is a lot more developed, and being able to expand into other economies gives you a little bit of an opportunity to bring down those costs and therefore allow you to be a bit more competitive from a pricing perspective. I suppose, given the involution, which, by the way, is also an interesting word that it took me a while to actually learn about. I think in other places, there's a limited comparison to this, but if you think about hyper-competition in the venture space, it's usually just about a war chest and cash burn. But in China, it is hyper-competitiveness driven by various, I guess, state and other support for individual businesses. But the process of hyper-competitiveness basically means that Chinese competition allows usually it to be the lowest cost producer in the world. And so from an FDI perspective, it is not so much a cost arbitrage issue as it might be access to new markets, perhaps transfer of technology and understanding of kind of local enterprise and so on. So the nature is somewhat different. But at the same time, I don't think that ASEAN would be particularly picky about which form it receives. It just is a matter of what the comparative advantages are for each economy, and therefore the type of investment that the type of capital flows you like to see into the economy to have them develop.
All right. So thanks. So just sum up the conversation this panel's been having over the last 20, 30 minutes. The first point is ASEAN returns and growth have been poor, relatively poor over the past decade. Mainly because probably there hasn't been enough transformational leaps in the products we have been making for export. Part of that is a capital issue, or an FDI issue, right? I guess the no new industrial FDI kind of means no new premium products that we can sell, and therefore no higher wage jobs, right? I guess the second point is ASEAN faces external shocks from the US and China, which are difficult to predict, they're difficult to manage, and they're sure as hell difficult to capitalize on. And it's not just ASEAN, really. It's a problem of the whole world, right? So, and then increasingly you see sovereign wealth funds around the world, like PIF, being compelled by their governments to reinvest domestically to kind of achieve with DDI what FDI has done in the past, right? And Kevin, are you under pressure to buy more maple trees in Canada? I mean,
We do invest in agriculture as well, but no, maple trees not specifically. So we are invested, I think, over $115 billion in Canada. So there are very few investors worldwide who are more heavily invested in Canada than CPP investments already to begin with. The fact that every country is undergoing a bit of a review and possibly a renaissance of industrial policy does mean that investment opportunities might be attractive across the globe, including in Canada, and it's something that we are watching very closely to see if we could do more on that front. Ultimately, it depends very much on what your source of capital is and what the purpose of that capital is meant to do. I think Dato' Faisal shared that Khazanah has a dual mandate, which in many ways is very meaningful. Different institutional investors have a very different set of mandates and objectives and constraints that they have. And depending on what that pool of capital is meant to do, it may focus more on, say, international diversification or stability of capital or growth. It may focus more on not putting all your eggs in one basket, or perhaps contributing to domestic development as well. And depending on what those pools of capital are, they really should focus on their purposes. The last thing you want is to have mixed mandates that are not well defined, because that results in perhaps potential disappointment from a returns perspective or from a pension security perspective for the savers. And at the same time, you may not be able to achieve some of the other development objectives that could perhaps be better achieved through fiscal policy or other forms of domestic investment. So it really depends on what the pool of capital is meant to do.
And who, in your view, has balanced that pressure on returns and the liquidity asks for more DDI? Who's done a good job and how?
Is that a setup to say Khazanah's done a great job? Because I absolutely think so. Again, really across the globe, I think what you find is there is a greater recognition that there is, ironically, so much capital in the world, but yet a scarcity of capital for productive investments. And sometimes, specifically, if you're concerned about national security, if you're concerned about domestic development, as a result of reorienting supply chains, as a result of changes in economic linkages and trade linkages, I think that hasn't fully played out, and so it's unclear which funds will ultimately be able to balance that better. There are changing national policy objectives everywhere in the world, and so there will be some adjustments to those mandates as well. I think it's a little bit early to be able to gamble, or there's humility in not knowing who actually has the right mandate and how they'll end up doing as the world shifts.
All right, and a question for all my panelists, going back to this title, is there light at the end of the tunnel, right? My guess is, I would frame this in my mind, it's really a race against time. On the bear side, you have US AI capex cycle, which kind of looks peakish, right? It's gone way overboard. It's really aggressive, and I don't know whether this is 2000 all over again, right? And on the bull case, I have China successfully shifting its economy towards a more demand-led or consumer-led economy, which actually supports global growth instead of just leeches on it, right? So it almost seems kind of too binary. How do the three of you think about this? Kevin, on your portfolio, I mean, can you sleep at night? I mean,
with jet lag, actually, it's hard to sleep at night. But beyond that, when you think about the light at the end of the tunnel, like we were joking about, sometimes it might be an oncoming train. That is usually the worry. The only free lunch is diversification, for better or worse. I know it sounds like a very boring thing to say, and I'm a portfolio construction person, so it's an occupational hazard for me that diversification is always the thing you look for. But at the same time, if you think about where financial markets are and how concentrated they are in tech, in AI, in the US in particular, all of those things mean that when you want to perhaps manage the potential downsides in various scenarios where unexpected things might happen, being diversified, looking across different economies, trying to look across different sectors, that is the only way to try to make sure that the light at the end of the tunnel isn't just that oncoming train or that slow-moving train wreck, but there actually is some daylight to it. The worry that I have about how we think about AI right now is I think there is a lot of unknowns and a lot of unknowns and a lot of uncertainty to it all, and I think some of the future panels might cover some of this. It's not clear whether all that spending on AI today is grasshopper activity or if it's ant activity. If you believe that it is mostly going to be literally song and dance and entertainment, AI is probably grasshopper activity. If you believe that there is going to be a fundamental shift in productivity, that it is going to fundamentally change how we work, how we live, how the world actually is productive, then it is ant activity. And a lot of that may be channeled towards that kind of growth, and every country would want to have a piece of that, and every company would want to have a piece of that as well. But it really depends on how you assess that. And unfortunately, it is very hard to tell right now. So the fact that there is a lot of financial capital going into that space may not necessarily be a bad thing. It's just purely from an investment perspective. If you think from a fiduciary duty, being able to participate in that is one part of the responsibility, but making sure that you're not caught completely off guard is the other part of the responsibility, which is where some of the diversification, some of the, reorientation of capital to other parts of the world outside of North America, to Europe, to Asia, to ASEAN even. All of that is almost a necessary part of the conversation for all institutional investors.
And Shan, will we ever see a Chinese consumer who consumes like an American? And what can ASEAN sell to that consumer, right? And don't say durians, okay? Durians, verboten.
Okay, so I'll start with your question, but I actually want to address Kevin's diversification argument a little bit. So Chinese consumers, it really depends on how you look at consumption. Like if you look at the volume, Chinese consumers already consume a lot. It's just the price that are cheaper. So when you look at the total value, then they are not as much as the others. And then so again, back to the renminbi appreciation. If we're looking at renminbi appreciating by 5% a year, probably over the next 5-10 years, China will be able to make up the gap in terms of the value between China and the US consumers. And at the same time, we're looking at Chinese consumers coming back to exploring the world a little bit. Like before, for the pandemic, it was really the years that Chinese consumers looking inbound and traveling only within China. But now we're seeing that there is a gradual recovery in terms of their interest to the world as their firms go abroad. There is more exploration going on. Like Chinese consumers go to places that are not very popular before, and they are not going in groups. Groups, they buy a lot of things, but it's the individual experience that matters for Chinese consumers now. So we are having a new generation of Chinese consumers. They are looking for experiences. They are not looking for buy things. So actually services, I think, is still a very important and a growingly important value for Chinese consumers. They have too much to buy within China, and they don't have much experiences within China. So that's on the consumption thing. And circling back to Kevin's diversification, I think about it a little bit. And one thing that I think is that in addition to diversification, there are some strategic choices to be made. We think that China's EV sector is very successful now, but China has been investing in the EV sector like in 2006. And that took almost 20 years for the sector to succeed. So this was a strategic decision. And 10 years ago, I was at a US think tank writing a paper about how much failure China's EV sector was. Now we're talking about the opposite story. So it takes time for things to happen, and sometimes you just need to hold up to that position. All
right. And ASEAN trapped between these two giants. It's like a kid stuck in the middle of a divorce, right? You gotta love both your parents, but you can't take sides, can you?
Light at the end of the tunnel. If you're on the stage here, you will notice that the spotlight that is shining on us is blinding. So there's a lot of light there. So in a way, I think there is light at the end of the tunnel, and I think how ASEAN deals with the great power competition, I think is essential. But let me highlight one very important point. I think that I'm leaning more towards how the change in China will affect ASEAN. In a way, it's very transformative. If you've been to, trying to add on to what Shan is saying, if you've recently been to Vietnam, the number of Chinese tourists there It's incredible. And we are seeing that shift happening, the consumption shift that's happening in China. And there is very interesting research work being done when it comes to China on how the consumption is actually not that low. By CF40, there was a growth researcher who looked at it that the actual volume of consumption is actually quite high compared to upper middle income economies. In fact, it's most likely higher than most of them. It's just that the costs of buying those goods are actually very cheap. And that ties into how productive Chinese economy is. Now, for ASEAN, I think what is key is that in the past, ASEAN has always been tied to these shifts that's happening in China. I think in a way, if you think about it, I can like maybe like share 3 key inflection points that's tied to China and how ASEAN has been navigating it. So the first one was 2000 when China entered WTO, and that kind of like hollow out a lot of the export competitiveness of ASEAN. But that shift quite rapidly to China being a global manufacturer, to China also becoming a global consumer. By about year 2009, global financial crisis time, ASEAN actually relied more on the final demand from China than the US. That's when the tipping point happened, 2009. So that's when actually ASEAN rely more on the consumer of China than the US. And now 2024 is the point that I raised earlier. There is that shift from China being more than just an exporter of goods, now it's an exporter of capital. And that, I think, will rewire how ASEAN can navigate the next couple of decades. So in Emerald, we have actually been working on trying to see what needs to be done for ASEAN as a region going forward in the next 20, 30 years. So this month is the ASEAN month. The ASEAN Summit will be end of this year. We hope to share some of the findings during the Leader Summit. But one of the key things is this. ASEAN integration has always been linked with a broader Asian ecosystem. So much so that the ASEAN integration itself has been stagnant for the longest time. About 20% of our share of export is with each other. And our FDI with each other is even lower, it's about 10%. In fact, it's been declining. We don't really FDI each other, so we don't really invest in each other countries that much. So going forward, I think 2 key things need to be done for ASEAN to actually make sure that we actually have a better growth trajectory. One is actually how we can leverage on our external linkages, especially those as our linkages with China, and how we actually can use that to actually upgrade ourselves domestically. So the next one is actually how can we internationalize or regionalize our firms, so much so that we can actually have more investment with each other. So it has to move beyond UOB, it has to go to Jollibee. That's what I've been telling my colleagues, right? I mean, a lot of our investment with each other has been in banking system. Related ones, right? CIMB, UOB, and so on. But we need more like, Mr. DIY, Jollibee, and the likes, where SMEs itself can participate in the regional market more effectively. So these 2 will be key, and we did some simulation, and we'll actually most likely double the level of integration within ASEAN by 2050, and much more than what just trade policies can do. Which implies that, in a way, if you think about it, if we talk about how we can actually domestically upgrade from FDI, as well as how we can internationalize our firms, we are actually looking at some form of an industrial policy for the region, narrowly defined, perhaps, right? That will retain our openness as a region, but at the same time, provide us with a strategy for us to grow better going forward.
All right, but coordination is always going to be tough, right? It's like the European Union, right? It's a nation-state impediment.
There is more. That's one. I think one of the bright side from the beginning of this year with the Trump administration is actually there's significantly more momentum within the ASEAN community, ASEAN leaders, and ASEAN Plus community, such that they would want to actually do more things. So I am a bit hopeful in that sense because I'm from an ASEAN Plus 3 outfit, so. There is more momentum. Sure, things can be gradual, coordination can be difficult, but there is progress.
Okay, great. Anyway, thank you. And I think we still have some time to take some questions from the audience. I think there are attendants with paddles to let us know if there's, please let us know if you have any questions. Just
while we're waiting, I just wanted to share anecdotally, there is Jollibee both in Singapore and in Canada, so yeah.
And Malaysia.
There you go. So global consumer is still well alive.
But I love that. UOB, from UOB to Jollibee, right?
I could have chosen CIMB, so it's the same. CIMB to Jollibee.
All right, there is an online question right now, or maybe we'll take number 3 first.
I'm Fang Wei. I'm involved in semiconductor sector, right? I just want to ask if, I mean, we in Malaysia, we have actually experienced the Western world investments in Malaysia or in this region. When we look at China, for example, when you look at investing into our country, obviously there's this consumer sector, which we know that you are targeting a particular consumption. But when you look at, say, Chinese companies in other sectors, you know, I don't know, now automotive is looking at Malaysia, maybe other sectors are looking at Malaysia. What do they look at? Is it the consumption, or is it they are looking at the base to also go global? You know, yeah, that's all. Thank you.
Shan.
Yes, I think they are doing this almost by intuition. So the companies in China right now is that evolution is so tense, so that nobody earns money. So the choice for them is to go abroad. It's almost like not by choice, it's by pressure at home. And China is slowing down. When we look at the numbers, by real GDP growth, it's not that not that different. But if we look at nominal GDP growth, before 2015, China basically grew by over 10% a year. Recently, we're talking about nominal GDP growth of only 4% something. So this growth is really not good for company profit, and they have to go abroad. And when they think about where to go, the first destination is always ASEAN. It's just that the familiarity is close and it's easy to move the supply chain. So all of this make ASEAN a very good destination, and probably a lot of the companies don't even know what they're aiming for. And when we look at the numbers, ASEAN probably accounts for roughly 40% of China's outbound investment. So that number has been growing, especially in recent years. And a key reason is not only for ASEAN, but also to access the global market. So we know that the tariffs from US, from UK, from EU are rising, and Chinese companies, one is to go there to invest directly in Europe and US, but the other way is to invest in ASEAN and access the other markets. For them, for the Chinese companies, there are different companies making different choices, but the pool is really large. And as the Chinese companies on the coastal area, they are more inclined to go to ASEAN markets because this is closer.
All right, so to paraphrase your answer, it's basically they're being pushed out, and it's really trying to look at ASEAN as a source of demand, right? As consumer demand, right? Okay. Number 6.
Hi, good morning. I'm from the research team at Khazanah. Thank you for the session, very insightful. I would like to ask with regards to, say, like the idea of internalization among like ASEAN countries, how could, like, say, these companies approach this as we see, like, again, more countries trying to focus more on domestic investments? Could there be some wariness about, like, even like among ASEAN partners, like, you know, oh, there's foreign companies coming in, trying to eat up local businesses? And also the second factor being that China, again, because of, you know, its expertise in manufacturing, costs are very low. How can, you know, say a Malaysian firm in, say, Vietnam compete with almost as absolutely like cheaper items from China?
My question again?
I think it's for Alan and maybe Shan. Yeah.
I think before I answer that question, I would like to actually challenge Rid's summary earlier, which ties to that question. Rid, you said that returns from ASEAN has been weak for the past 10 years. Yeah. I want to disagree with that characterization because I think growth has been good, employment stable, and so on and so forth in ASEAN. The thing is, the return from ASEAN is so open and so integrated in global supply chain that the return that ASEAN contribute does not manifest in our local markets.
I see.
It's Intel, it's Toyota from Thailand, and so on and so forth. So, and AI, we are so tied to the AI supply chain at the moment, but it doesn't just appear in. So I think for internationalization of ASEAN firms itself, I think we need to look at the opportunity. There's a lot of barriers when it comes to setting up companies within ASEAN. If you want Malaysian company want to set up in Indonesia and so on, there's a lot more requirements and so on. But I think one thing to look at is actually the sheer size of demand of ASEAN. So ASEAN by 2027, if not next year, would actually be larger than Japan in terms of GDP. So ASEAN is not small. ASEAN is actually really huge. Japan is the 5th largest economy in the world. And if you take ASEAN plus 3, if you take a broader regional take, ASEAN plus 3, you sum it up, is about 29 trillion nominal GDP. That's about the size of the US. And we are growing faster than the US. So ASEAN plus 3 being China, Japan, and Korea. ASEAN plus 3 will be the largest region, larger than US going forward. So in a way, if you are a firm in Malaysia or in Thailand and so on, and if you think that you want to actually capture some markets, ASEAN is equivalent, if you want to penetrate ASEAN, is equivalent to penetrating the entire market size of Japan, right? And if you want to think of plus 3, it's like targeting the US in terms of just the scale. But of course, I think a lot of policies will need to be in place. And I think that's one of the advice that we have for policymakers within ASEAN. How can we encourage our firms to be able to invest more with each other? So I think one of the ideas that came out was from ASEAN Business Advisory Council on this thing called the ASEAN Business Entity. I'm not sure how much traction it's getting, but that is a very good start. It's basically a way in which an entity could start in Malaysia. It could be recognized mutually in other ASEAN countries. That could be a good start in which how we can actually internationalize or regionalize our firm.
Right.
Yes, so when we look at the numbers, it's actually quite interesting that ASEAN actually exports quite a lot to China as well, not just to the US. So it's, when we think about how to bring in Chinese investment, probably a better way to think about is, why do these companies go to ASEAN? What do they need? And what are the things that ASEAN could offer to these companies? So we just mentioned that Chinese companies are already very strong at manufacturing. But China still, if you look at the numbers, it is very dependent on the rest of the world as well. It's just dependent on different things. Before, it depended on technology. Now with the Made in China 2025, it's dependent on the inputs. So that's something that ASEAN could offer, because still there are materials that is cheaper here than in China. China cannot do everything. And the second thing is that Chinese companies need channels to access the demand, as we just mentioned. That is happening in the EV sector between China and Europe. Like BYD accessed the European market first by cooperating with the local retailers. And even the solar industry, like you need workers to install the solar panels onto the roof, and Chinese companies themselves don't know how to do that. So there is this access question that Chinese companies are looking for partners to invest in ASEAN, but they don't know how to do that. And overall, with all these small things, like again, trust is being built up in the process. The two sides, Chinese companies and ASEAN markets, they cooperate, and over time they build trust. And with all these transactions, and in the near term there are transactions, but in the long term, it is how you develop a partnership. And so that helps align the interests of the Chinese companies with the local markets, and that helps them to stay. Not just like manufacture here and export, but also to upgrade the local value chain.
Right, but I mean, it's like it's kind of growing pains in the sense like the Chinese FDI. Look at how it's done in Indonesia, right, where you have a lot of FDI into the nickel space. So now you have a pretty big nickel mining and battery export business to China. But on the other side, the Chinese FDI has also gone into things like textiles, apparels, and things, and they're killing the local SME businesses in apparels and textiles. But then if you think about the political aspects, nickel and batteries don't hire too many people. Apparel hires a lot of people, and they're losing their jobs. And so it's all growing pains, it's all adjustment, right? And we got to...
I was just about to raise this point actually. I think we cannot underestimate the socio-economic cost of this adjustment that's happening. And Indonesia actually had, the case that you point out is actually very interesting in the sense that it's not just the FDI, it's more like the imports from China in garments that is actually creating that pressure on local firms in producing. So there is that very strong anti-Chinese FDI sentiment or anti-Chinese import sentiment in some sectors. But at the same time, if you look at ASEAN itself, ASEAN actually offers a diversity of experiences. So Indonesia might be fighting back against the imports of Chinese made clothes and so on. But if you look at the two biggest global producers of clothes in ASEAN, Cambodia and Vietnam, they can compete with China, one. Secondly, they are working with China to actually build their textile supply chain, in which case those two economies managed to turn that into actually a comparative advantage for them, and they are like so key in the global supply chain. I think that actually these cases actually presents a way in which we can look at how we can leverage on the capital that's coming in and to actually upgrade domestically. So I'm not saying that things are perfect in any ways, but I think it offers a lot of lessons that we can look into more closely.
All right. Oh, one more there. Yeah, number 5, please.
Hi, good morning, everyone. My name is Chi Yong. Recently, I think the investing committee has been talking about China's second shock, and this is a question I would like to ask Shan in particular. And what do you think about China's second shock? And also, what is the one major misconception about China that investors actually should take note of when they consider their investment strategy or whatnot? Thanks.
It's a very big question. When we think about China's shock, so it's very difficult to find one way to say what does it really mean, because China is also a very big economy. To some extent, it doesn't really want to do anything, but it still has to be put in that position to be responsible for a lot of things. And so with China growing economy further, I think that has to be a reality that both China and the rest of the world needs to deal with. And so we think that one perception, if particularly for this year, is that because I look at the US-China dynamics a lot, and the biggest misperception is that China's economy is really weak. And that was the starting point about all the discussion about renminbi depreciation, about the US is holding the upper hand in negotiation. But right now, it's pretty clear that China's economy is not as weak as at least the headline data shows. It has its own problems, and Beijing has been trying to address some of the problems, including renminbi evaluation. But at the same time, this is really, like from China's perspective, China values stability. It doesn't happen overnight. And for any people to think like China having a big stimulus that one that solve all the problems, I think that is not going to happen. And probably adding to that is China is also facing its own problem about employment. And that's the tech problem that everyone is facing. That's actually where people can cooperate to deal with the shock from the AI. And for China's point of view, we are seeing that the latest policy is trying to encourage the service sector, because it is the manufacturing sector that creates value, but it's the service sector that distributes the value among everyone. So we actually think that this is where that more opportunities would exist, not only for China, but also for every other country that is investing in the service sector. Manufacturing sector is not the only thing that matters.
All right. Alan, can ASEAN grow rich through services? It's always been a headcount, numbers, bodies game, right, for services traditionally, right? Think about tourism, for example.
Yeah, I think I agree with Shan in the sense that services is essential because it redistributes income growth within the economy, in the sense that services sector is the largest employer. The problem with services sector is that it's so large. In fact, when you say services, it can range on, you can think about anything. It can be services sector. That if you just don't build something in a factory, or if you don't have mining or a farm, is services, right? We are in services sector, right? Retail is in services, and so on and so forth. I think one is key is to appreciate the fact that services sector generates the most job, but services sector is very diverse, and technology is in fact making such that the services sector itself is much more exportable than previously. Digitally deliverable services. I think what is the key to manufacturing, and I think manufacturing is still really important. We cannot give up on manufacturing in ASEAN. But the key to appreciate that manufacturing is such an important ladder for development is because it is not limited by domestic scale, right? You can export it over, so you can rely on external demand. Now, technology could be changing that for services. Services, you tend to think of it as haircut, so therefore everything is domestic. But with digital technology and so on, like instant translation and so on, we could be reaching a point in which services might not necessarily be limited to just domestic market. It can be actually global, and when it has the scale, then it can actually be playing a role that is perhaps more similar to manufacturing. So in a way, you need to make sure that both sectors, all sectors in the economy, in fact, improve in its value addition and its productivity. And services sector is key. In fact, if you just focus on manufacturing and ignore services, what will happen is that most likely you'll get more strain in the social economy, the society side of things rather than the economic side of things.
Yeah, I guess it's about balance. I think we reached the end of this panel session. Please give a hand to my panelists.